Joining me right now with more global economics editor for the Wall Street Journal, John Hilsenrath, and president of the American Institute for Economic Research. We have Edward Stringham. Good to see you both. John, I'll start with you. I mean, the investors are kind of freaking out over what I would say is actually a good thing. The expectation of inflation, something that a normal economy should have, right?
Well, Trish, I'd say there's a few things going on right now. One is we're getting what I would call a spasm of volatility. I wouldn't call it necessarily a return of volatility, but we're getting this spasm. And the reason it's happening is that a lot of traders on Wall Street were invested in vehicles that bet against market volatility. And what's happening is some of these trades are unwinding. And as those trades unwind, it creates more volatility. So, I think that's a spasm that still is playing out, and it's why we're seeing the markets go up and down a lot.
All right. Is that related then to algorithms and computers that are doing all of this?
Well, it's related to products that were created because we've had so many years of calm markets that people made bets that we would continue to have this calm, and these bets piled up. And what happens when they start unwinding is they create the opposite of what you're betting on. So they were betting on calm, and now we're getting the unwind of these trades. So we're getting the opposite of that. We're getting more volatility.
So if that's the case, though, it should eventually end.
It should play out. But I think there are two real warning signs that these markets are sending. The first one is that, the economy is picking up, and that's fundamentally good news. But we've also gotten a lot of signs in the last week that government budget deficits are rising, that government borrowing is going to be rising. We're talking again about trillion-dollar deficits related in part to this budget deal that was just done. That's putting long-term pressure, upward pressure on long-term interest rates, which I think is scaring people a little bit. And then the final thing I'd say is that central banks have pumped so much easy money into this economy through their bond buying programs and low interest rates. And as they step away from those programs, we see asset prices that were very high seeing some downward pressure.
All right. But, this is all kind of natural stuff. I mean, Edward, I see you shaking your head there, especially when John started talking about all that money that we're expected to keep on spending, money that we do not have. But, come on, let's face it, this is kind of how we roll, right? I mean, the Fed was doing it.
Well, I mean,
and the government's been doing it for years. Why should this, spook everybody to the point where, you're looking at 500 points of a sell-off?
I mean, we can kick the can down the road a long, long time, and we've been doing it for a long time. But eventually, these chickens are gonna come home to roost, and we are gonna have to be paying for these budgetary deficits and the increases in debt.
That said, I mean, I'm an investor, say, who's looking at the next 6 months, and the chickens will come home to roost at some point. But they're not going to come home to roost next month or 6 months from now. They're going to be painful for my kids or your kids and their grandchildren. But it's not going to hit us in 6 months' time. So getting back to why is this market reacting so negatively to good economic news? Isn't it the expectation of inflation and the fact that, hey, there's more competition for equities? I mean, why not go get a CD at your local bank if you get a shot of actually earning any interest on it?
Yeah, that's another factor. So there's been a lot of easy monetary policy for the past few years. A lot of people say, well, is this going to start showing up in markets? And, we do see these high stock prices. And, from an overall perspective, that's good. But part of it could be because of inflation. Maybe it's not real gains.
I think that's a lot of this. But let me get back to just, the fundamentals here. And we look at price-to-earnings ratios of roughly John Hilsenrath, 17, 18 right now. We're trading around 18 times forward-looking earnings. And that's nothing compared to, say, where we were. I mean, you want to talk about an asset bubble. You can go back to 1999 and 2000, where we were trading at much higher PE ratios. So, John, should people sort of take a deep breath here and say, okay, it's not like we're up around 25 times earnings. I mean, if you were, then you might say this is getting a little crazy, but we're still within the norm.
So Trish, I do think there's some fundamental underpinnings which were going to help this stock market. One of them, as you say, is earnings. The earnings season has been pretty good. Something like 80% of companies have been beating expectations for what they're going to report on profits, and as a result, forward-looking price-to-earnings ratios look pretty modest. So that's good news. and global economic growth is pretty strong right now. The whole world is growing. Those are all that's all good news. But I just think we have to keep in mind that there are these other things going on. There's a party going on out there, and Washington is a part of it, with deficits that are rising to $1 trillion. And while those deficits, aren't going to come home to roost for many years, the market, when it works, is supposed to be forward-looking and price those things in today.
I know, but
and that's why
it's looking
interest
out
rates
6
are
to 9
rising.
months, John. In the next 6 to 9 months, it's not as though interest rates.
We could be hitting trillion-dollar deficits in the next year.
So do you think interest rates are going to spike to, say, 8% on the 10-year between now and the next 9 months?
No, but we're heading towards 3%, which isn't very. It's not very high, but it's still a percentage point higher than it was a year ago.
Well, all right, but as long as you have growth underlying that, I don't really see that as a big problem. I think it's getting us back to normal.
Yeah, I think one of the great things over the past year, we've seen a lot of deregulation. That's clearly good for business, American business, American stock markets. So, markets did go down by 5% this week, but it's still 5% of below an all-time high. So it's not the worst thing in the world.
John, good to see you.
Great to be here.
Edward, thank you very much.